Hi class, this video is going to run through how to make an income statement from closing entries, and it is exercise 11.1, which you'll find on your textbook on page 228 and your workbook on page 109, but the question is up on the video as well. So what have we got to do here, guys? We are making an income, our first income statement, from closing entries. So remembering, closing entries mean that we have already determined profit and closed off our revenue and expense accounts, closed off our profit and loss summary account and transferred it to our capital account. We've done all the hard work of determining profit, but we now need to make an income statement, a report that gives us all this information in an easily understandable report, which we can analyze and give to our business owners. The hard work is done, and we actually already know that our profit, so our end result in this report, is going to be $23,400, and we've already identified the revenue accounts, the revenue being cash sales and credit sales, and we have 5, so we have 2 revenue accounts and 5 expense accounts. Our revenues equaling 50,000 and our expenses equal 26,600, hence where we get our 23,400. We need to pick this information up and put it into our income statement as part A, and the template is there already. So let's do this. We have 2 revenues. Both of these are part of sales, part of net sales, so they're going to go at the top. And we have cash sales. And our cash sales were 24,000. And because there's 2 of them and there's 2 columns, we always put if we're going to have to add numbers up, we put them in the left column. And we have credit sales, which is 26,000. If we add these up, we're going to add that up, obviously. That equals $50,000. And that will give us this will give us our net sales because we don't have any sales returns. If there were sales returns, they would be part of this closing entry here, but we don't have any. What do we then have to do? We then have to less costs of goods sold, and cost, which is an expense. We're now up to the expense part. And cost of goods sold is going to be cost of sales minus any other expenses that would get the inventory into the condition and location ready for sale. Custom duties, buying expenses, or anything that says in it. Now, if you go through the other 4 expenses, they have nothing to do with getting our inventory in the condition and location ready for sale. So instead of saying less cost of goods sold, we can just do this really quickly and say less cost of sales. How much are our cost of sales? So if we've ticked off our revenues, we can now tick off our first expense, 23,400. And because there's just one of them, we don't have to put it on the left-hand side. We can put it on the right column. 23,400, apologies. This will then give us gross profit of 26,600. Gross profit being our net sales minus all our costs of goods sold. We then will have 4 other expenses. Now you notice that we don't have an inventory loss, an inventory gain, so we don't have adjusted gross profit, and we don't have any other revenue that we would add as other revenue. So if you don't have any of those things, you don't need to put the headings in to just report an adjusted gross profit, which is the same as gross profit. So all we're going to do to finish this off is add the 4 other expenses. These being advertising, postage, office expenses, and our assistant wages. And it makes sense to put the information down in the same words that we've got as our ledger accounts. So we're going to put those numbers in and we will put them in the left column because we do have something to add up here. $1,200, $200, $600, and again $1,200. Now if we add all of these up, we've ticked off the 4 expenses. This will equal $3,200. So if we go 26,000 minus 3,200, we're going to get our net profit, which is 23,400. And we've done our income statement. So it's a relatively short, simple one. And you would stop and go, am I confident that I've done this correctly? We have a check. We already calculated our profit in our closing entries, and we have absolutely reported the same number there. So we've done our income statement correctly. Part B asks us to prepare the balance sheet, and we've got a little bit of additional information. We've got starting capital of $65,000, and we have some drawings of $10,700. So capital at the start is going to be $6,500. This is our starting capital, how much our business was worth at the start of March 2023. We will add the net profit of $23,400. If this was a loss, we'd write less net loss. And then we add these up, and this equals $88,400. And this is telling us that our business is worth now $88,400. This is the number that balances our balance accounting equation and balance sheet. But we've also taken some money out of our business, $10,700. So we're going to say less drawings of $10,700. And that means our end capital is $77,700. And we will write end capital here, and we should put the dates. End capital as at 31 March 2023. So guys, we have now successfully done exercise 11.1, making a simple income statement from closing entries, and we've reported our closing capital in our balance sheet to represent the increase in profit minus our drawings. Well done for following on this question. Now it's time to practice this and to move on to making income statements with more revenue and expense accounts from a trial balance where you'll have to also identify them. Keep practicing your accounting.